Have you ever wondered how the 70-30 rule can change your financial life? Well, let's break it down. The 70-30 rule is a financial principle that can transform your approach to money management. It suggests that you should live off just 30% of your income. Yes, just 30%. The remaining 70%, that should be invested wisely, so you're not just earning but growing your income too. Sounds simple, right? But how does it work in reality? Let's dive in. The 70-30 rule might seem like a challenging task, but it's simpler than you think. It's all about channeling your income effectively. Picture your total income as a pie. According to the 70-30 rule, you slice this pie into two unequal parts. The larger slice, which is 70% of your income, is set aside for investments. These could be anything from stocks to bonds to real estate or any other form of investment that suits your risk tolerance and financial goals. Now, the smaller slice, which is 30% of your income, is what you have left to cover your living expenses. This includes everything from your rent or mortgage, groceries, utilities, transportation, and any other personal expenses. The key to making this work is disciplined spending and smart investing. Imagine you have a monthly income of $2,000. According to this rule, you'd invest $1,400 and live off $600. So the key is to live frugally, invest wisely, and watch your wealth grow. Let's recap on the key points about the 70-30 rule. This strategy is all about disciplined spending and smart investing. By allocating 70% of your income towards investments and surviving on 30%, you open the door to potential wealth growth. It's crucial, however, to remain consistent and patient. Rome wasn't built in a day, and neither will your financial empire be. Remember, the 70-30 rule isn't just a number game, it's a lifestyle choice for a secure financial future.